Satellite radio, yes, the thing you forgot existed, might actually be one of the most quietly interesting value plays hiding in plain sight right now. We're talking about a company that Berkshire Hathaway owns 37% of, sitting at a forward price-to-earnings ratio of around 8.2, paying you a 4.3% dividend just to wait. 5 years ago, Sirius XM shares were flying high on the strength of exclusive content, captive audiences, and the kind of moat that looked unassailable. Now, those same shares have shed nearly 60% of their value, and the obituaries have practically been written. So what happened, and more importantly, is the story actually over, or is this one of those moments where everyone's looking the wrong way? The catalyst behind the collapse is almost embarrassingly simple. Your phone got too good. When Apple CarPlay and Android Auto turned every dashboard into a smartphone mirror, the locked-in, pay us or get nothing model that made Sirius so powerful started quietly crumbling from the outside in. Spotify, Apple Music, and YouTube didn't even need to beat Sirius at their own game. They just made the game irrelevant for millions of casual listeners who weren't devoted enough to Howard Stern to justify a monthly subscription. Think of it like a specialty grocery store that dominated its block for a decade. Then a massive supermarket opened next door with free parking and a coffee bar the loyal regulars stayed. But the curious ones? Gone. There was a time when headlines called Sirius a revolution, when exclusive deals felt like moats, and when the idea of a subscriber churning was almost quaint. That optimism has aged about as well as a Sirius XM car installation in a 2007 Buick. The psychological hangover from that hype cycle is real, and it's made investors either fiercely loyal or deeply scarred, with very little middle ground. Warren Buffett's involvement through Berkshire cuts both ways. Psychologically, on one hand, smart money doesn't accumulate 37% of a dying business by accident. On the other hand, even Buffett has said his best holding period is forever, which is a great philosophy unless you need the stock to actually move. The bulls will quote Liberty Media's long game, and the bears will quote your Spotify premium subscription, and honestly, both of them have a point worth respecting. Here's the historical context that rarely gets mentioned. Media disruption cycles almost always overshoot on the downside, punishing companies that still have real cash flows simply because the narrative has turned negative. Cable television was supposed to be dead 10 years ago, and some of those stocks quietly tripled while everyone was busy writing the eulogy. A 60% drawdown sounds catastrophic until you remember that Amazon fell nearly 90% after the dot-com bubble and came back to rewrite the entire retail industry. The pattern of disruptor becomes disrupted, becomes undervalued is practically a business school case study at this point. Sirius free cash flow is expected to hit roughly $1.3 billion in 2026 and approximately $1.5 billion in 2027 as capital expenditures decline materially. That's not the financial profile of a company in hospice care. The misconception worth confronting directly is that streaming killed satellite radio the way the internet killed print. It didn't, because satellite radio still serves a specific defensible use case: long road trips, rural dead zones, and the kind of deeply habitual listener who has Howard Stern on every morning like a religion. Exclusive content is a moat, not a guarantee, but it's a real moat, and channels dedicated to specific artists alongside polarizing personalities like Stern and Megyn Kelly are betting on loyalty being stickier than algorithms. The fear that this is a melting ice cube is worth examining honestly, but a 4.3% dividend yield and a sub-9 forward price-to-earnings ratio price in a lot of that fear already. You're not being asked to believe in a turnaround miracle, just to acknowledge that the market may have overcorrected on pessimism. History rewards that kind of contrarian patience more often than it rewards chasing the thing that's already priced for perfection. The practical lesson here isn't to bet the house on satellite radio's renaissance, it's to recognize that distressed narrative stocks with real cash flows and institutional backing often reward disciplined, sized positions held with patience rather than conviction bets made from excitement. Position sizing is everything in a situation like this. If you're right, a small allocation outperforms. If the thesis breaks, you live to fight another day without a catastrophic drawdown on your overall portfolio. Process matters more than prediction here. The investor who buys a small, deliberate stake sets a thesis with clear milestones like free cash flow growth and subscriber stabilization, and doesn't check the stock price every morning, is going to dramatically outperform the one who either panics out at the bottom or bets everything on a hunch. Discipline without emotion is the edge that almost nobody actually maintains under pressure, and that gap is where real long-term returns are made. At its core, the Sirius story is a reminder that value and narrative are almost never aligned at the same time. Value shows up when the story sounds bad, and the story sounds great when the price has already moved. Whether this rebounds toward fair value or continues to fade, the disciplined investor knows they sized correctly, collected their dividend, and let the thesis play out without losing sleep. We may not know exactly where Sirius lands in 5 years, but we do know that the combination of Berkshire's conviction, declining capital expenditure, and growing free cash flow creates a setup worth watching, with clear eyes and a calm hand, and sometimes comfortable uncertainty is the most honest position you can hold. And if you're looking to put that same kind of disciplined thinking to work in real estate investing, home contracting, or finding the right lender, check out the links in the description below and let us help you get started.